welcome you all to Personal Finance 102 with RightWise Wealth, facilitated by alumnus Caitlyn Driehorst and her teammate Chris Casale. During this webinar, we'll share a ton of best practices and tips how to get started with cash, investments, insurance, and retirement planning. This event does kick off our Young Professional series, in case you didn't know, which will feature a ton of industry dinners across several cities and some professional development webinars geared towards uh, alumni in their early career to mid-career journey. So if you are interested in attending, I just dropped the link in the chat for you to register for our amazing events. As we dive into today's conversation, please feel free to submit your questions in the Q&A box and we'll address as many as possible during the discussion. And then after the webinar, a brief webinar will pop up and we'd love to hear some of your feedback. And then lastly, a recording of this conversation will be sent out along with some additional resources by the end of the week as well. All right, so now I'm going to pass it over to our lovely hosts, Caitlyn and Chris.
Awesome. All right, so let's see. How's my screen sharing? Can everyone see my slides?
Yes.
Looks good.
Fantastic. All right, so thank you guys all for joining. Just some compliance notes at the top. Today's conversation is all about education. This is not financial advice. These remarks are general, and as we like to say, this is where your work should begin, not where it should end. I'm super excited to be coming back and speaking to UChicago groups. Thanks to everyone who reached out to Kashima before the presentation. We were able to modify our content to specifically address some of the things you guys asked to hear about. And so we really appreciate that. So my name is Caitlyn Driehorst. I'm the founder and the CEO of RightWise Wealth. I attended UChicago. I graduated in 2011. That's my parents. You can see my mom looking really cold, and that's because it actually was really cold in June in Chicago at that time. At UChicago, I actually majored in Russian literature, so that's not really salient for today, but shout out to all the liberal arts kids here on the call.
Hey, everybody. My name is Chris Casale, and I am a financial advisor here at RightWise Wealth. It's interesting. My journey into personal finance started really early in adulthood. I had bills that were starting to pile up. I had student loans. I was starting to think about, okay, eventually I want to build a family and a life. And I had majored in finance and was about to take this job in corporate finance. And I was like, fresh out of school, I had this new degree. And I was like, wait a minute, I'm not 100% sure on my own personal finances. And that sort of like kicked off this 10 years of diving into learning everything I could about personal finance and, just sort of getting really interested in the space. And so hopefully some of the content we have here today can hit home for you and drive that curiosity as well. Next slide. So we just want to go ahead and say, as we're going through the materials here, please reach out. If questions come up, if something comes up even after we go through the material, you have our email addresses here. You can set up a Calendly meeting with myself. I love to talk about this stuff. I particularly love the educational component of this. So if anything really resonates with you, yeah, reach out. Let's schedule a meeting and let's chat. Next slide.
All right, so for today, we're going to start by talking about how much cash is just right. We're then going to go a little bit deeper into how income taxes work. I think many people think that everyone else learned this someday at high school and maybe you had mono. They actually never sit down and explain adults how this works. So today is the day. We'll explain to you how taxes work. After that, this was a big question that came up in the comments that we received prior to the session is, how do you know if you should be prioritizing your 401k over a Roth IRA and what actually is the difference between those? Next, we're going to talk about how do you get started with investing. If you have too much cash and want to start investing in the markets, it can be intimidating to start. We'll give you the entry point for that. And then finally, we'll wrap up with just a quick word on some insurance basics and a little bit of some facts that often surprise people about end-of-life planning. Earlier, I joked about being a Russian literature major, and many people thought that that was useless. And then I found a career where we talk about death all the time. So shout out to my Dostoevsky intensive that I took.
All right, let's talk a little bit about cash here. So really, the idea here is we want to have you know your number, right? And the way that we best explain this to clients and through educational webinars is through this idea of, okay, how much do you want to have in your checking? How much do you want to have in your emergency fund? And then how much do you want to have sort of outside of that? And the goal here, and it's a bit nuanced, but for the most part, you can use these numbers as rough estimates of checking 1.5 to 2 months of expenses, right? Emergency fund somewhere between 2 and 10 months. This will vary depending on your job. This will vary depending on your life situation. But in most circumstances, it'll fall somewhere between that 2 and 10 month mark. And then the other thing that we always like to call out is, hey, if you see something coming up, maybe you're about to get married, maybe you're thinking about having children, maybe you just want to plan this big vacation, right? Uh, Great. You should consider just having a little bit extra, basically tied to whatever that larger expense is. Once you've hit that point, we start to recommend, okay, you're ready for investments. You can start taking some of the money above all of these different buckets, if you will, and start putting that into investment accounts and start to see that money grow, through time, grow through compounding, grow through diversification, right? And we'll get into all those things in the future. So ultimately, think about your cash in terms of really three buckets here. You have your checking, which is that kind of short-term amount, your emergency fund, longer term, and then any additional major purchases. Next slide.
Yeah. I like to say we only see two types of clients. We see people who have way too little cash, and we see people who have way too much cash. And they can both be problems. So find your little Goldilocks.
All right. So, from here, once we sort of have talked through your cash number, once we've gotten a good idea of where that stands, we get into taxes a little bit. And what we want to explain here, what we want to show is, how do income taxes work? Because sometimes, honestly, they're a little bit confusing. And what we're going to do here is just sort of break that down a little bit, show some things that, we'll talk a little bit about deductions and things of that nature to maybe just clarify it just a little bit more for you. Next slide.
All right. So here is something that I think is not obvious to people and even confuses, I know I was recently talking to my parents. I realized I don't think that they necessarily have understood how this always works. So here's your moment. Let's talk about how federal income tax brackets work. What we're going to do is first walk through how they work, and then we'll walk through a very specific example to show it exactly. So the first thing is your brackets vary based on your filing status. The two most common are single or married filing jointly. We run a different webinar called Money and Matrimony. If you're curious on how getting married can change your finances, that can be a great one to attend. So starting over here with the brackets on the left, if you are single, the way this would work is the first $11,925 you earn, that is taxed at 10%. If you earn $30,000 this year, if you earn $300,000 this year, that first 11,925 that comes in is always taxed at 10%. So what about the money that you earn above that? All of the money that you earn that is between $11,926 all the way up to $48,465, all of that money is taxed at 12%. It proceeds like this up the brackets. So what I often find many people will think happens is they'll say, well, I earn $120,000 a year, therefore I must be taxed at 24% on all $120,000 because they look over there on the columns and they see that. That is not how it works. It's the money that fills up the bracket and then overflows up into the next bracket. I think this is not intuitive. The technical term for this is a progressive tax. When you hear people talk about America has a progressive tax system, That's what they're referring to. Then on the right, you can see the married filing jointly number. That is the total income for your house. So for both partners who are in this, is your combined income that pulls you into these different brackets. So you can see those numbers look different.
So one of my favorite parts actually about being a financial advisor is helping clients make sense of their taxes, mostly because they can be super confusing, as we've talked about. I mean, is it we have this progressive system, we have different tax rates going to different dollars, right? And so being able to help just break that down into these bite-sized chunks is something I really enjoy. And in doing so, one of the ways that we show is sort of what you're seeing on the right-hand side is just, how it operates from the top, from that gross income, and what gets deducted along the way. So once you understand, okay, there are these different tax brackets, then everybody kind of asks this question, which one do I fall into, right? And I think Caitlin explained it. You sort of hit each of these brackets along the way. But the question is, what does it go up to, right? Because the way that our tax system works, it's not just as simple as looking at your salary, right? There are some other pieces to it, which really ends up being a benefit, but those are called deductions. And there's two types of deductions, right? There's these above the line adjustments or above the line deductions, which happen first. Think of things like a student loan interest or even your 401k contributions, right? Those are types of things that would be above the line. And then you would get down to this number called your adjusted gross income. From there, you would either take a standard deduction or an itemized deduction. Now, in most cases, standard deduction is much more common. There are certain circumstances where itemized deduction makes more sense, but ultimately, once you take that, you get to your taxable income, right? And that's the number that you're going to go ahead and revert back to your tax bracket for to figure out what is that tax rate. Next slide. So to sort of put some numbers and some context around this, we put together an example for you of our friend Lee here. So Lee is earning $125,000 and she's got a $15,000 bonus. She's going to contribute $10,000 to her 401k. So when we look at this and think back to that setup we had on the previous slide, you've got your Lee's gross income, which is going to be 140,000. That's just the 125 plus her 15. Then we're going to deduct those 401k contributions to get to an adjusted gross income of $130,000. We get that standard deduction of 15,000 and Lee's taxable income is $115,000. I'll pause for a second because I know that was a lot of numbers, and you'll eventually be able to see this example. But the idea is you're really looking for what is that taxable income number. So let's do the next slide here. All right, so this slide is really going to tie in what Caitlin was talking about a few slides ago with the brackets and the progressive nature of those brackets in the Lee example here. So you can see that when we start to break down each bracket that Lee is paying in, she's paying the full amount in the 10% bracket, the full amount in the 12% bracket, the full amount in the 22% bracket, and then just $11,000 gets applied to that 24% bracket. Okay? And so ultimately, we end up getting two different tax rates. One is called the marginal rate. I'll start there first. This is just what she would owe on that next dollar, right? So if Lee made one additional dollar, it would be taxed at 24%. That is Lee's marginal rate. However, she's not actually paying that, right? She's only paying, when you go through the math and do the math at each level, she's only paying $20,000, about $20,500, give or take, right? So when you do the math on that, it comes out to 18%, right? So the effective rate in this case, what she's actually paying is lower than the marginal rate. And the reason for that is because of some of those deductions that we talked about beforehand. So hopefully that makes sense and brings some clarity around taxes for you. Next slide.
Yeah. So two misconceptions I often hear, and confession, Caitlyn in her 20s did not know this stuff. So I'm excited to make you guys smarter than I used to be. The first misconception I'll hear is people will say, well, it's great I got a raise, but unfortunately, now I'm going to go up a tax bracket. And so I'm actually going to lose money, even though I'm getting a raise. The reason that people think that is because they think their whole income is taxed at that marginal rate. That if they go up from 22% to 24%, their whole income will now be taxed at 24. We now know that's not how this works. If you get a raise, you earn more money. It does not affect the how you were taxed on all of the earlier money that you made. So that is a misconception. That's not how taxes work. The next one that I hear is people will say, oh, well, I got a 10% bonus. But of course, I don't get to keep as much of that because bonuses are taxed at a higher rate than salary. Confession, I thought this for a really long time. The reason that I thought this, the reason that many people think this is that you see your paycheck come through every 2 weeks and you have an idea of how much of that is withheld based on just like kind of eyeballing it. Then you see a bonus come through and you're like, oh, I clearly am taking home a lot less of this bonus than I am of my paycheck. The reason that it works this way, that's actually just the withholding on it. So when you earn extra money, remember your extra money is at this marginal rate because it's filling up your highest bracket. And so a bonus, it's always your extra money, it's going to be withheld at this higher rate. However, your paycheck, because that comes through every week, that is being withheld at your effective rate because it accounts for all of the earlier money that you made that was in the lesser amount. So your paycheck is withheld at the effective rate. Any bonus that you receive is withheld at your marginal rate. But when it comes time in April for you and the government and TurboTax to get together and decide what you actually owe for the year, your bonus money and your paycheck money are all in the same pool, and they will all be owed at this effective rate. So apologies if that's a little confusing. Please put any questions in the chat. I know it can be a little non-intuitive, but those are two myths that I often hear when people think about tax brackets. All right. So why did we go deep on income taxes? Was that just nice to know? Some good trivia to make you even more popular at cocktail parties? No, actually, it's important because we want to talk about whether you want to prioritize contributing to your 401k or to a Roth account. And so to understand this choice, you need to understand a little bit about how income taxes work. To understand whether you want to contribute to a 401k, which is a pre-tax deduction, or to a Roth account, which is a post-tax account, you first need to understand how taxes work on investing. So first off, we're not going to go as deep here, but just to give a basic intuition, when you invest with just general investments, so if you put $5,000 into a Robinhood account, the money that you're putting in is quote unquote post-tax money. It's money that you already paid paycheck taxes on. So you've already paid taxes today. Then when you make money, you'll owe taxes on the gains in those accounts. Your 401k and Roth accounts, these are retirement accounts. They are accounts that you get a special tax break on. So these are tax advantaged accounts. Why do you get a tax advantage on these? Remember, the government uses taxes to encourage or discourage certain behaviors. The government doesn't want you to smoke cigarettes, so they charge extra in taxes on cigarettes. The government does want you to save for retirement, so they offer you tax breaks on retirement. Shout out to everyone at Booth in the econ department at UChicago who's written a lot of ink on this structure. So the way it works is for a 401k, you do not pay any taxes today on that money, right? So this money that comes out of pre-tax, you owe no taxes on that today. Remember, let's come back and look at how this looks for Lee. Lee makes 140. 10,000 of that is not going to be taxed because she put it into her 401k. That's why we call this a pre-tax account. No taxes on it today for a 401k or a traditional IRA. Then on a 401k, you don't owe any taxes on gains while it's still wrapped up in that account. Now, let's say you're 65. Let's say you're going to start taking some money out of your 401k. Fun fact, you will owe taxes at that time. Many people will look at their 401k and say, oh, this is great. I have $250,000 to help support myself in retirement. JK, friends, you do not actually have $250,000. You will owe taxes on the money that you take out in retirement, and you will owe those taxes at the income rates. Now, this is different than a Roth account. A Roth account, it's money that you already paid income taxes on, right? So for Lee, it's going to be the money she earned minus this 20,447. It's her leftover money that she can put into a Roth account. However, when she puts that into a Roth account, she will never, ever, ever again owe taxes on that money that comes out. So if Lee looks at her Roth accounts and she says, I have $100,000 in Roth at age 65, when she goes to pull it out, she owns all that money. She doesn't owe another nickel in terms of those taxes. So taxes today versus taxes later.
So one of the things that is interesting here is if, for example, Lee or anyone were to have the same tax rate their entire lives, there would actually be no difference between pre-tax and post-tax accounts. So one of the benefits and one of the thoughts is, okay, when do I invest more into these pre-tax accounts versus these Roth accounts, right? And so that will ultimately vary based on your individual scenario, and there's of course different limits. Oh, sorry, Caitlin, can you shoot back to the previous slide? Thank you. That will vary based on limits and other variables. But ultimately, one thing to keep in mind is if you paid the exact, or if you were in the exact same tax bracket the entire time, you would ultimately owe that same tax rate. So looking here at this example, right, you can see this was the 25% tax bracket or tax, right? And ultimately, at the end of the day, whether you put it in pre-tax or Roth, it came out to the same amount. Next slide. So one of the things we really want to show here is, okay, how does this work and how does this actually relate to real life? So for me, it's kind of funny. I remember graduating from college and I was like, okay, I'm going to start my career and work for the same company for the next 30 to 40 years. I'm going to climb the ladder. I'm going to have these incremental tax rate increases and really be on this career path that looked very smooth, very upward sloping, very similar to the one on the left-hand side of your screen. That didn't actually happen, right? Real life had different plans. There were some curveballs that came in. I had some changing interests and some unexpected opportunities that came up, including going back to school to get my master's degree, right? And so my career trajectory looked from a tax rate perspective looked much more like the one on the right-hand side of your screen, where you start to go down one path and then maybe things change a little bit. Maybe you go back to school and you go into a lower tax rate. The cool thing or the fun thing with financial planning is there's actually a lot you can do even in the years that you have low income years. And so that's a lot of strategy that we work with our clients, especially those who either, go back to school, maybe they go into a different career and have to take a lower paying job, whatever that might be, right? So the point is that even though you might be thinking similar to me, you're going down one path and one career trajectory, that can change. And then those tax rates will change over time as well. Next slide.
All right. So remember, we said the difference between a 401k, traditional IRA, these pre-tax accounts, and the post-tax accounts is, do you want to pay taxes today or do you want to pay taxes later, right? So if you are in a high income year, so let's say you are in your 30s or your 40s, these are your highest earning years. Let's say it's a year where you're going to get a weirdly huge bonus, or if there's some other reason where you're going to have really high income that year, then you're going to love that 401k deduction. That is going to be all day long. So high income years, you don't like your tax rate today. You want to lower your taxes today, and then you want to pay taxes later. So think about when you're 50, 65, you're in retirement, you're not working. You're doing something really cool, like say going back to grad school for a master's degree in English at St. John's College, a very specific dream that very much is mine. I will probably earn no income that year. That'll be a great year for my tax bracket. That'll be the year when I want to pay income taxes. So if I'm in a high income year, I want to tell the government, no, 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 don't tax me now. Tax me later when I'm poor. Now, a Roth account, remember these post-tax accounts, that's when you want to say, oh no, today I am in a lower tax bracket. I'm in the earliest part of my career and I'm still waiting on the universe to acknowledge how amazing I am and give me a huge raise. Or say you're in grad school right now, or you have a spouse who's going to stay at home for a couple of years and take care of a child or a parent. Those years when your household income is lower, you are going to love those Roth accounts. It's like, baby, I am being taxed at like 18% right now. I'm being taxed if my effective rate is at like 15% right now. Lock that in. And then later in life, I don't have to worry about it. I don't have to fuss. I've already paid taxes on that money, free and clear. I mentioned in the chat, we are actually doing a whole webinar on strategies for low income years, and that's coming up. So if you're laid off in grad school, know someone who is, feel free to register for that. We go really deep on some of these strategies.
All right, so we've really covered cash, we've covered taxes, pre-tax, post-tax. So now we're going to start talking about investing and really everything that comes along with that. A lot of fundamentals here, things to just consider when you consider investing, where you put those next dollars, really after you've filled your cash and your retirement account buckets. So let's take a look at that, Caitlin. All right, so I've got three main principles here for you today. The first one is compounding and taking advantage of compounding, right? This is kind of like the this is like a snowball, right? And as it starts rolling down a hill, it gets bigger and bigger. Compounding really acts like that. The longer it rolls, right? The bigger it gets, the earlier you start, the larger it gets in the long term, right? So the idea is you want to take advantage of that momentum early on so that 10, 20, 30 years down the road, you've had all that time for your investments to start compounding, right? And that brings me to my next principle, which is, stay invested over this time. Time is a key resource for investing. If you start today, and we'll show you in just a second how powerful it can be, you will see huge dividends over the course of the next 10, 15, 20 years because of the compounding that we just discussed, right? So things that really impact your accounts in the future are compounding, and staying invested over time, and then diversification, right? This is, don't put all your eggs in one basket. I think we've heard this a number of different times, right? But if you're spreading your money across all these different types, whether that's investments, whether that's other types of assets, right? You start to reduce your risk and you smooth out that ride, right? It might be a little bumpy at certain times, But over the course of the long term, over the course of those decades, right, you're minimizing risk and you're maximizing some of that reward, right? So just be thinking about these principles as you're going along. So this is the slide that I was really excited to show you about. This is the Federal Reserve Bank of St. Louis, and we have two different investors. One starts investing at age 25, invests only for 10 years. She invests $5,000 for 10 years, right? And does not invest anymore after hitting age 34. Investor number two starts at 35, invests for the next 30 years, so 3 times the amount of years, right? And then ultimately at age 65 stops investing. They invest the same amount, and you can see the difference, almost $170,000 difference in the two investors. And I think when you look at this image, it's so powerful to see what compounding and what time can do for your investments. As we just talked about, those two principles plus diversification, that's where you can really see this monumental growth in your investments. So you cannot underestimate the value of time here. Next slide.
All right. So start early and let that money compound so that you are earning interest on your interest and the money is working for you. Now, if you start early, the other thing that's challenging is staying invested over time. This is something that I'll hear a lot. We heard it a lot earlier this year when Trump's tariff announcements meant that the stock market was suddenly, dramatically underperforming. We saw a huge loss in a single day. I had clients who were like, "Oh my gosh, should I get out of the market? Should we sell my investments before they go down even further?" And I think everyone kind of says, "Yeah, sure, yeah." Like, well, if I saw the stock market go down, I would stay invested. But I want to take this moment, really truly think about how hard you work to save $10,000. Now imagine you invest $10,000. Now imagine you see your account and it is now worth $7,000. And you're like, "Do you know how hard I worked for that $3,000? And now it is gone." Sit with that for a moment because it doesn't feel good. Now, look, there's a lot of nuance here. You can get a master's degree in this topic. You can get a PhD in it at UChicago. But just speaking very generally and not for anyone's individual circumstance, broadly, while investing always includes the risk that you could lose the money that you've put into the market, over the long term, what we've seen is that there are more periods that are positive than that are negative. And the problem is that if you hop out of the market and you sell your investments at the time that they are really low, you may not know when to put your money back in. One thing we know about the stock market is that historically, market gains have not been like the slow and steady up and to the right. Instead, what we see is that it's very jumpy. And if you are out of the market at a time when the stock market jumps back up, that recovery period will not be there to be a tailwind at your back. There's an apocryphal study that says that Fidelity did a study of who are the investors on our platform who have had the best results over the long term. What do they have in common, all of these people? And the story from Fidelity goes that when they looked at the people who had the best investing results over the long term, they had one thing in common. Many of them were dead. What those people had done, because they weren't alive to trade their accounts, they had left their money in to grow over time, and they were able to take the greatest advantage of compounding. There's a cliche, only check your 401k once a year on your birthday, so you are not exposed to the ups and downs. Definitely something to consider. Again, nuances that time horizons vary. This is not specific financial advice. These are general principles.
So the final principle that we have here is diversification, really. The idea here is you want to have different types of assets, different types of asset classes within a portfolio. So when you think about it, right, if you have one stock of any company, right, you have one stock, and you invest solely in that stock, you ride the highs and lows with that stock. That stock could go to the moon. That stock could come, that stock could go down, right? And it is very, there's a lot of risk involved with that. Certainly a lot of reward, but also quite a bit of risk, right? And when you're thinking about money that you're going to need in the future, thinking about money that you might need for saving for a home, maybe you're potentially starting a family, you want that money diversified, and you want that money, the risk associated to that money significantly reduced. And so the way that you can do that is you can do that through investing in a diversified portfolio. So what does that mean? Well, it can mean a lot of different things. You can diversify within asset classes, right? You could have stocks, you could have bonds, you can have other types of assets, right? And then you can also diversify across different asset classes, right? So you might be really interested in tech, or maybe you even work in tech, right? And you get compensated through stock options from your tech company. Well, it might make sense then to invest in something outside of tech to offset that. Because let's say tech as a sector just, has a bumpy couple of years or a couple of months, right? You have another stock or another asset class to effectively even it out. So you're not as exposed to that specific sector or class, right? And so here what you can see, this is just sort of an example of how you can be allocated across different holdings, right? We've got large cap, small cap, mid cap, international, and so on and so forth, right? So this is just an example of really what diversification is and why you can really limit that downside, but still have pretty maximal upside.
All right. So you know that you have done a good job of setting up your cash accounts. You are sitting on the right amount of cash. You are ready to start putting some of this money to work for you, maybe in your 401k, maybe in a Roth account, or maybe in a general brokerage. How do you get started? It is pretty intimidating sometimes. So here's how you can actually get started, even if you only have a couple $1,000s to invest. The first thing you can do is you can leverage a target date fund in your retirement account. If you log into your 401k and you see a fund that says something like Vanguard Target Date 2050, Vanguard Target Date Fund 2055, that is one fund that will be diversified and automatically mix everything that's within the fund to adjust itself as you get closer to retirement. So a target date fund, if you just want to plop some money in and let that puppy ride, that is a great way to get started. The next way that you can get started is just by buying a single fund that's diversified. I see many people who are like, well, I want to be diversified, so I need to be in many different types of funds. That can be true. However, if you are just getting started with a smaller amount of money, an example of a well-diversified fund is Vanguard Total Market, VTI. This is an ETF. Over here to the right, this would be one example of a very well-diversified fund. You could just buy this single fund, and that would be a good way to get started with just a couple $1,000s. Let's say that even that starts to feel pretty intimidating. You're like, oh my gosh, like I don't want to go through. It's asking me if I want a market order or a limit order. What should I do? I love a good robo-advisor for just getting started. We use Betterment for their advisor application for our clients. Betterment is a great robo-advisor. Wealthfront, what they can do is you can just answer a simple quiz telling them what you want to use the money for, what type of account you want to open, and then they will automatically invest that money for you. And they tend to do that for a pretty low fee. So if you have a couple $1,000s and you want to just get started, these are some actions that you can take. All right. So let's try and stop with a couple minutes of the hour. I've got some great questions in the chat. If you have questions, go ahead and put those in. We'll go through those. Chris, let's move this pretty quickly just to provide some general principles for people on insurance and end of life.
Sure. Yep. So quickly across the board, there's just different types of insurances. You probably know about health insurance, but there's also life insurance, umbrella insurance, which sort of just sits on top of home and auto, and then disability and long-term care. In a lot of circumstances, these insurances can come through your workplace, right? But it's always a good idea to also consider some independent policies in addition to your workplace. And again, depending on what your life style looks like. The big picture here is know that these insurances exist. If they are offered through your company, it's generally a pretty good deal and something that you would want to take advantage of. But also make sure that you're fully covered in each of these different categories. And I'll leave it at that.
Awesome. All right, so end of life planning. Earlier, I was joking. My Dostoevsky classes talking about death was very useful for my job as a financial advisor. Just two things I think are really important for people in their 20s to understand about what would happen if you were to pass away. The first thing I think is important to understand is how your assets are distributed if you do pass away. You might have seen on many of your financial accounts, they have these things called a beneficiary designation. I highly, highly recommend that you go through your financial accounts. You make sure that you have someone's name listed on each of your accounts and that you stay on top of that over your lifetime. If you list your mother or father as a beneficiary and they pass away, make sure you update your account beneficiaries. If you list your sister and then she gets remarried and changes her last name, update her name on your financial accounts. If you get married, make sure that you change your account beneficiaries to be the name of your spouse. This feels like paperwork. It feels really annoying, but it's really important because if you did pass away, those financial accounts would not necessarily be distributed by your will. If you have a will, that your will distributes your physical property and, fun fact, crypto. Crypto does not have an account beneficiary designation. But the account beneficiary designations actually override your will. And so if your will says, I want all of my financial accounts to go to my second husband, but your first husband is still the account beneficiary designation on your 401k, if you pass away, first off, it'll probably go to some court. But someone you didn't intend could end up receiving your money if you haven't stayed on top of your account beneficiary designations. So, fun fact, do that. The other thing that I think is just important for people to understand about end of life planning is just the importance of staying very organized. Look, this is a webinar for people who are in your 20s. Statistically, it is very unlikely that you will pass away anytime soon. But because it would be unexpected, it would also be exceptionally difficult. Could someone fully resurrect your financial life if you were not there to direct them? Does someone know that, like, cough, cough, you still have a Citibank checking account that you don't really use anymore because that was the one that had the ATM, in Cobb? So the best way to do this is to make sure that you have all of your documents organized. This is a download the handouts. We'll send this out as an attachment from Kashima. And we'll send out this handout. It's just a list of all of the documents that you should consider having organized. All right, so that is the end of our planned topics. I'll go ahead and stop the screen share now and go through some of the questions. All right. So the first, let's see. I'll go through the Q&A and I'll go from first to last. All right. So we talked about Roth versus 401k. All right, Chris, when you are in retirement and you are withdrawing from a 401k account, how do those taxes work on the money that comes out of a 401k? Is that tax the same as income, or do capital gains apply?
So you are being taxed as when you're taxed in retirement, right, what happens is it sort of applies the same way. Like if you have any income, um, then you will also that will also be taken into account from your taxes as well, right? So there is what's called required minimum distribution. Depending on your age, you are sometimes required to take out taxes. So, to take out some of your withdrawals. So there is this balance of, okay, when do you start to take out those withdrawals, knowing that you are going to be taxed into that future amount?
So, all right, we have a question here about Roth contribution limits and Roth qualifications. This is a fantastic question. So one of the differences between a Roth account and a 401k is one, not everyone is eligible to contribute to a Roth account. If you make more than a certain amount of money, then the government says you're doing great. You don't need this special tax rate. There's some things you can do. There's something called a backdoor Roth. There's a couple different strategies. But if you make too much money, you no longer qualify to contribute to a Roth account. The other difference between another difference between a Roth and 401k is that contribution limit. So, Chris, what's the Roth limit for this year? It's like $7,000.
It's over $7,000 for this year, and I guess it depends on whether you're single or married. But so just keep that in mind as well. But yeah, those are going to end up being two separate accounts.
Yeah, so the most you can contribute to a Roth is, call it somewhere around 7,000. The most you can contribute to a 401k, it's 22,000 now, right? 22,000
That's
flat,
that's a little higher, 23,500.
23,500. These numbers
And
adjust
so
every year
those
with inflation.
and those so for the 401k, again, that can double up, right? If you have a partner, if you're married filing jointly, you can go up to 47,000 total.
Yeah, so both partners can individually contribute up to the 23,500 each in a 401k. All right. Some great questions in the chat. Sorry to keep promoting these webinars. We just have like some ones that are really applicable for this situation. How should I think about rebuilding after a setback and after taking care of an adult? We have a webinar coming up called Difficult Financial Conversations with Aging Parents. For those of you who I've been joking, Taylor Swift said, "I'm the careful daughter of a careless man." For those of you who sometimes feel those vibes, we have this webinar coming up on how you can help your parents prepare for their finances. If you're rebuilding after a setback, the first thing I would do is concentrate on rebuilding your cash reserves and repaying your high interest debt. So if you took out credit cards to help smooth out a transition, concentrate on getting those paid down so that you can avoid compounding interest. And start rebuilding that cash reserve. So it's going to be initially the 1.5 monthly expenses in your checking, and then the 2 to 10 months in your cash savings. After you've rebuilt those basic foundations, then you can start working towards other goals like retirement. The other thing I would just say is there is so much shame associated with money, and it really frustrates me because it is not necessary. If you have had a setback, that does not make you like anything wrong with you. That is actually tremendously normal. And you should feel proud of having survived. You should not feel shame about needing to rebuild. That's my little soapbox. All right, we have a question here about high yield savings accounts. Love high yield savings accounts. Interest rates on those right now can be 4 to 5% on many of these. Many of them are very similar. If you are evaluating different high yield savings accounts, the things I would look for are what is that interest rate that it will be paying for you? Obviously, higher is better. Look for how many times it will let you make withdrawals. Some high yield savings accounts will only let you withdraw, say 4 times a month. Now, realistically, your checking account is the one that you want to be paying bills out of. So you don't need to be making a lot of withdrawals, but it's still something that can be different. And then also just the ease of use. Some high yield savings accounts are more difficult to use than others. But I would highly recommend looking at these. Many bank savings accounts pay minimal amounts of interest. I would look at things like Betterment and Wealthfront. Both have high yield cash accounts that can sit next to your investments, which is very easy to use. Capital One and Goldman Sachs Marcus are two other examples of high yield savings accounts that have really nice mobile apps and are very easy to use.
I would just add they're great for those emergency savings that we talked about because you are continuing to earn a decent amount of interest outside of outside of your checking account. So if you are, storing cash for somewhere that is anywhere really from 3 to 12 months, it's a really good spot for that because you're still making money, you're still kind of keeping up with inflation and so forth. So that's just another point there.
We have a great question from Mia. Should I do only 401k, only Roth, or a little of both? Mia, that is a fantastic question, and your brain is absolutely heading in the right direction. So some of it depends on the extremities of your income. So if you are in a very high income year, say it's a year that you got a bonus, you and your spouse both got a big promotion, then first off, you might not qualify for Roth. But then also you're going to really want to maximize that pre-tax deduction. Now, let's say that you are in an exceptionally, a lower income year. Let's say you're in grad school, or let's say you have a spouse who's going to take a couple years off to care for a dependent. Then you might really want to concentrate on both you and your spouse really hitting those Roth accounts hard because you're in an exceptionally low income year compared to the rest of your trajectory. Now, let's say you're somewhere in the middle. You are earning a good amount of money, but you're in your 20s. You're like, psh, like I'm going to get promoted like 18 times before my retirement, but you're still earning a good amount today because you're awesome. At that point, you might want to contribute to both accounts. You might want to have some in 401k and you might want to have some in Roth. This was a mistake. I've dropped this blog post in the chat. This was a money mistake I made. My first year out of college, I accidentally maxed out my 401k. I really wondered how I was making all this money and where it was going. In retrospect, that probably wasn't the smartest money move I could have made because that was my very first year out of college. The rest of my career, I would make more money. And so what I wish I had done was in that first year out of college, really prioritize the Roth account. But I was still saving and it was still investing. We have a question about restarting after divorce. Yeah. So first off, again, just I hope you feel strong. I feel like coming out of divorce, it's a process that can make you feel really small, and money can start to be very weaponized. We have worked with a couple different clients who've gone through that, and that is always my first advice is just taking a moment to pause and breathe because there's a lot of anxiety and trauma associated with divorce. Um, we have this webinar running Money and Matrimony. It's really intended for people who are going into marriage, but it can still help you understand the dissolution of marriage. That webinar link is there in the chat. We do work with many clients who are going through a divorce. It's something that I often like to recommend because it's a place and a time to work with a neutral party who can look at your situation objectively and really help you reflect on and love your future at a time when you've been really looking backward. For working with a financial advisor, we do not require a minimum investment to work with our firm. Many firms will say you can only work with us if you can bring over 500,000, if you can bring over $1 million to invest. We do not require that people have a minimum investment to work with our firm. If you are a one-person household, to work with us starts at $4,000 total for the first year, and that is billed monthly. Guys, this has been fantastic. I sincerely appreciate you all taking the time. I know all of you are busy. You have many other priorities in your life, and you took this time to try to get better and to invest in yourself. So thank you for that. We don't take it for granted. It's sincerely appreciated. We're going to send Kashima some links to send out and some PDF handouts. We did not talk about student loans today. Student loans are a big area for planning. And so we'll send out a PDF resource for how you can think about prioritizing debt versus investing and some other student loan forgiveness items. Those are also things that we love to work with clients on, especially where student loan repayment is complicated when you have a high earning and a low earning spouse with public service loan forgiveness. If you have any questions, Chris's email address, I'll put in the chat, is chris@rightwisewealth.com. Mine is Caitlyn@rightwisewealth.com. You can tell we're huge nerds who love to talk about this. And so if you reach out, you're never being a burden. You're literally just asking us to talk about our special interest. Kashima, any words you want to close out?
Yes, thank you to you both for sharing really great advice and wisdom. I certainly learned a lot, and I hope our viewers did too. Before you go, as a reminder, feel free to fill out that survey. Your feedback will help us prepare and bring in more events, exciting events like this. So please take a moment to complete that. And thanks again for spending your afternoon with us. We really look forward to seeing you all again in the future. So thank you once again to Caitlyn and Chris.
Thanks, y'all.
All right, everyone, take care. Okay, so Caitlyn, Chris,